Good afternoon, everyone, and thank you very much for joining us. Great to be virtually together with you all for this discussion of the state of the SPAC world. Just briefly, by way of introduction, Ching Yang, Kate, Ian, and I are all transactions partners here based in Hong Kong, although actually I'm on the verge of splitting my time between Asia and Europe, starting in about 6 weeks. Like I suspect, many of the people who have joined us today, the three of us have spent a great deal of time over the last year or so working with clients on one aspect or another of SPAC type transactions. And given the steady flow of questions and interesting scenarios that are being put to us by clients, we thought it would be an opportune time to have a session to sort of talk through what's been going on and where we think things are headed. As an administrative matter, before we get started, there is CLE credit for this session. I will read out a code during the discussion, and participants need to write down the code on the form that's provided in the invitation link, and you submit that for your CLE credit. One other admin note: unfortunately, the way this is structured, we can't do live voice commentary questions, but there's a Q&A function that is enabled, and if you have questions, don't hesitate to submit them, and we'll try to get to them as we go through. And maybe on a related point there, I know that there's a fairly broad spectrum in terms of people's familiarity with SPACs, SPAC structures, De-SPAC deals, and so forth. And so if we are being too technical and you want us to back up, say so. And conversely, if people have more technical or more detailed questions and they think we're glossing it over, let us know, and we'll try to hone in on what's of interest to you. We're going to let Ching Yang start with this. The funny thing about the timing for us right now in talking about SPACs is that despite the fact that over the last 15 or 18 months, there's been an enormous amount of activity in the area, we're at a funny sort of a point because new SPAC formation has obviously slowed significantly as a result of some, regulatory and other developments, which we'll spend some time talking about. But there's still a great deal going on. There's still a lot of committed capital out there looking for transactions, and so in that sort of context, we organized this discussion to sort of give people a feel for what we're seeing and as I say, where we think we might be headed. Ching Yang, do you want to take it from there?
Sure. Thank you, Garth, and good afternoon, everyone. So as you can see in the agenda, today we will be covering mainly De-SPAC rather than SPAC, because I'm sure people have been hearing too much about SPAC during the past 18 months. And here is why we'll be focusing on De-SPAC today. As most of you probably know, that there has been an incredible increase in SPAC deals in terms of number of deals and value of deals during the past 18 months until very recently, right? I mean, as you can see, I don't need to give you the exact figures, but you can see that since April 2021, there's a significant weakening market for the SPAC IPO compared to a few months ago. And more importantly, as you can see, that there are over 400 SPACs already listed and is still searching for deals. And there are over 150 SPACs with deals announced and pending. And there are more than 50 billion capital locked in pipe, and there are more than 50 billion capital locked in the trust with redemption rights, meaning that those are the capital contributed by the public shareholders of SPACs. And before this session, I just checked the most recent number again, and not surprisingly, for the past week, the SPAC IPO market is still weak. Although we've been hearing bankers and other market participants that they suspect there will be a rebound in the next few months, and we're still getting SPAC assignments in this office, but the overall sentiment and overall activity level is no comparison compared to a few months ago. Now, there are other recent trends that shows a challenging environment for SPAC IPO. One is still downsizing. Two is there'll be increased hurdle on promote structure. So as most of us, most of the audience may already be familiar with, the sponsors or the promoters of a SPAC, typically they will enjoy promote shares and warrants. Those are the upsides or incentives for them to set up a SPAC. But we've seen, more and more deal structures that are more public investor friendly in a sense that they are thresholds and hurdles for the founders or the promoters to get the upside. And also there are tighter warrant structure. And warrant is an important structure for SPACs. More warrant means that there will be more dilution in the SPAC, when there is a real De-SPAC deal. And that represents the main compensation part or upside for the promoters. And if you look at a few more key numbers, first, on the one hand, the SPAC IPO market is weakening due to too many SPACs in the market. But on the other hand, it actually gives the SPAC market a huge opportunity. Because there is a demand and a supply and demand sort of mismatch. On the one hand, there are a lot of SPACs searching for deals. And on the other hand, the targets in the market, it does not just it does show up overnight. If you look at the De-SPAC deal volume during the past few quarters, there's a significant increase in the number of deals. And if you look at the equity value of De-SPAC deals, there's a healthy increase in the average value of De-SPAC deals. And also, if you look at the number of days between SPAC IPO and De-SPAC announcement, the period of time is actually shortening, showing that, on the one hand, the De-SPAC, potential De-SPAC targets, they're more educated than maybe 18 months ago about what a SPAC is and what the SPAC is, and whether this is the right venue for them to become a public company. So they're more well educated now. And on the other hand, you could see that really a lot of SPACs are competing for quality targets. The last table shows the number of SPACs searching for deals, and as mentioned previously, they are a lot. So we've seen, because of these dynamics, we've seen, SPACs, having more and more innovative, complex structures. And Garth, do you want to talk about some of the recent structures that we've been working on?
Sure. People will probably be familiar because of the press coverage with the recent Pershing Square Vivendi UMG SPAC. It's definitely an interesting one, and it has some elements that we thought would be worth talking through. As I'm sure this audience knows, in a typical SPAC, what happens is the acquisition entity merges with the target. And the SPAC shareholders end up with an interest in an operating company, a public listed operating company. And then there's questions about how their warrants are exercisable and so forth. But basically, it's a straight up combination. Pershing Square's deal was interesting because it's not that. Rather than a full-on combination, Pershing Square is taking a 10% stake in Universal Music, which is currently owned by Vivendi. And what will happen if you're a SPAC, if you're a shareholder or a unit holder in the Pershing Square SPAC, rather than ending up with your single interest after the transaction, you're going to end up with three separate interests. The UMG has been in the process of preparing to IPO on the Amsterdam Exchange. And as part of its deal with Pershing, it's going to carry on in pursuit of that listing. And when that listing is complete, and after the shares have been registered for distribution purposes in the U.S., Pershing Square will distribute the Universal Music shares to its SPAC investors. So your first interest will be an equity stake in a newly listed UMG group. You will continue to hold an interest in the underlying SPAC. It is using up a significant amount of its cash in connection with this transaction, but it's also going to retain a significant amount of cash. So it will be sitting on something like $1.5 billion after the UMG deal is complete, and it will carry on looking for a target with that pool of money. And it will do so under less time pressure than normally applies. As people will know, these SPACs are typically on a 2-year clock with some ability to extend in certain circumstances. But because the SPAC has discharged its obligation to complete a transaction, it won't be on the clock in quite the same way with respect to the surviving SPAC. And then the third feature, which is also innovative, and we'll see whether others replicate it, is a warrant that would be a warrant that is separate from the SPAC, and it's a warrant that is exercisable for something called a SPARC, which is a special purpose acquisition rights vehicle. And the key difference between the SPARC and the SPAC is that a SPAC, when a SPAC is founded, it is created and funded, it cannot have in sight a target, because if it has in sight a target, its registration documents need to address that, and it needs to provide information, including financial information, on the target. So an important condition of SPAC formation is that there haven't been any discussions and there is no particular target in sight. The idea behind this new Pershing Square vehicle, which will have a slightly longer life than a typical SPAC, is that it will not call the capital from warrant holders or give them the opportunity to exercise their warrants until it has actually identified a target. And at that point, if people want to exercise their warrant, they'll be able to. And as you can see from this slide, it's going to be if it all plays out as planned, it's going to be a very substantial pool for an acquisition. They're aiming for something like $10.5 billion for a combination. So definitely a little bit of an outlier in terms of structure, but we thought it was interesting. We thought it was worth sort of walking through that.
Yeah, so Garth, the traditional SPAC has basically a one shot. It buys one target and merges, whereas this traditional one, this Ackman Pershing Square one, gives you multiple targets and carry on at least a second round. Do you think that's going to be the way forward, or do you think this is a one-off transaction?
That's an interesting question, Ian. I think, obviously, if you think about the numbers that Qin Yang discussed a minute ago, just the sheer volume of SPACs that are out there chasing transactions, there's a lot of pressure in terms of the ability to identify the right sort of high growth traditional SPAC target company. And so there's a sort of a logic, I think, to the idea that people will start looking outside of, the traditional parameters and thinking about minority transactions of this type. So I think it's certainly possible that we'll see more of this. And in conversations we've had with clients, it's definitely something that people are studying. But I think there's also a wait and see approach, because the market reaction to this particular transaction has been a little bit up and down. There's, I think the complexity of it, I think, has caused people to sort of wait to see how this one plays out. And that might well have an impact on whether we see this kind of thing become more widely adopted.
Okay, thank you.
So I think, Xingyang, unless you had any other observations on the Universal Music deal, I think maybe we can move on to the Hong Kong discussion. Okay.
Yeah, thank you, Garth and Xingyang. I'm going to cover the developments in Hong Kong, and then as next slide will show that there will be three parts to talk about. What's the existing regulatory regime that is closest to SPAC listings? The term SPAC is not in Hong Kong, but there's equivalent. And then obviously with Hong Kong seeing how hot the market is, the regulators are thinking or have been told to think about viability of SPAC listings. And then the third bit we'll talk about is some of the challenges and other considerations that come into play. So as I say, SPACs are not a term in Hong Kong. It's a less complimentary term we have here. It's called shell companies. And then the essential thing is that neither SPAC listings nor De-SPACs are currently allowed in Hong Kong. So if you look at listing rule 14.82, it says that if the assets of an issuer consist wholly or substantially of cash, it will not be regarded as suitable for listing, and the trading in the securities will be suspended. So what is a SPAC? A SPAC is actually before a company that has cash, substantially cash. So that's not going to work under listing rule 14.82. And then listing rule 13.34 says that an issuer must have a business with a sufficient level of operations and to have sufficient assets of sufficient value to support its operations to warrant continued listing. And this was tightened not too long ago, because previously it was or you have a sufficient level of operations or assets of sufficient value. Now it's added as and. So obviously the authorities here look at it and say, look, shell companies without proper business operations are not suitable for listing. And when one does a kind of De-SPAC transaction here in Hong Kong, it is deemed a reverse takeover. And a reverse takeover is defined in Hong Kong as an acquisition of assets, which in the opinion of exchange constitutes an attempt to achieve a listing of assets acquired and to circumvent the new listing requirements. So what they're saying is that if you don't come through the front door and you're effectively, in the front door meaning, you go through the entire application process like you have an IPO, then if you are trying to do that and circumvent it, which is actually what many of the De-SPAC list transactions are, those will not be permitted. And then so we can go on to the next slide. And see what does the exchange say about shell companies. Where these shell companies enter into significant acquisitions, the exchange will apply the RTO rules to discourage shell activities. Very clear. And then these shell activities can invite speculative trading, lead to market manipulation, insider trading, and undermine investors' confidence. So, again, very clear guidance from the exchange as to what they think about these matters, which were published, this is quoted from 2019, but there are plenty of similar statements. And then let's look at the next slide to see what the SFC says. The SFC says, in recent years, problems associated with backdoor listings and shell activities have attracted wide attention. These activities can undermine the integrity and quality of our market and may affect investor confidence and market's reputation. And then they will say, they will not hesitate to use statutory powers to take action against the parties involved. So, clear statements from the stock exchange and the SFC that this is not what they want. And then when we go on and to the next slide to see what the Paul Chan, the financial secretary, was asked, and this was in March 2021 on Bloomberg. And obviously March was when there was probably the height, around the time of the peak of the SPAC market. So he was asked whether Hong Kong was open to SPACs. And he says, I will ask the SFC and the Hong Kong Exchange to work together, not just to look at SPACs, but to explore the viability of our own version of SPACs, right? Which will enable new fundraising. But on the other hand, it's going to uphold investor protection. So he's quite clear that he needs to find a way to kind of, to have both goals. We are looking at SPAC listings seriously. And then I think Bloomberg later reported that there was going to be a public consultation to be launched by June 24th today. And so far, I'm not aware of any consultation that has commenced. Okay. So Hong Kong doesn't want to be left behind, right? But what is next? So there is no clear time frame, as we saw, because the consultation hasn't come in. So I think at the moment they appear to be adopting a wait-and-see attitude, because obviously the U.S. regulators have had made certain statements, which Garth and Ching Yang will cover later on, and I wouldn't go into it now. But the pullback in popularity in SPACs globally could reduce the momentum, and it may not, and therefore SPAC listings may not be coming to Hong Kong as quickly as previously expected. But I think, as has been said by the exchange, we definitely Hong Kong looks at upholding investor protection, and to them they would say, and Charles Lee, the former CEO of the exchange, says that Hong Kong will probably allow SPACs and De-SPACs, but you probably have to go through a listing process. That's the only way to make it work, and it'll probably be making listing a little easier going through the front door. I'm not sure if we are going through the entire listing process, whether it makes any incentive for any companies to do a De-SPAC transaction or a SPAC transaction if we go through it that way. So whilst the SPACs to list would appear contrary to Hong Kong Exchange and SFC efforts to tighten the rules, we'll see what will happen in Hong Kong. But I think there are many De-SPAC assets. The target assets for De-SPACs are actually in Asia. So Asia and Hong Kong may still have a role as being the assets that are injected as part of the De-SPAC transactions. So with that, I think I'll hand it to Garth. Yeah.
No, I just want to make a comment. And I think in jurisdictions in other regions like Europe, there has been, SPAC activities, and I understand our European colleagues has been very busy on, SPAC transactions in European markets, in addition to the U.S. market.
Yeah, that's correct, Ching.
Yeah. Okay, so for recent U.S. regulatory developments, Garth, do you want to kickstart?
Sure. There is a correlation between at least some of these developments that we're going to talk about and the slight cliff in a couple of the graphs that Ching Yang presented earlier. There have been several several sort of waves of SEC focus over the course of the SPAC boom. I think, the four most consequential or most significant of those began back in December when the SEC gave pretty clear and stern guidance with respect to SPAC IPO disclosure, and they were focused in particular on conflict of interest disclosure. Obviously, one of the elements of a SPAC is the incentive that is created to get a deal done within a certain period of time. There's the time pressure element. There are warrants. There are financial incentives to various participants in pursuit of a deal. And the SEC, both in its general comments in December and in its comments on SPAC registration documents, has been probing to force people to say, how they're going to address some of these conflicts, how they think about them, and what they're going to do to try to align to the maximum extent possible the interests of the general SPAC investor shareholders or unit holders, and the interests of insiders who will ultimately potentially have control over how deals get executed. So that the impact of those statements continues to be felt, and I think, as I say, although new SPAC formation has slowed somewhat, people who are involved in that element of the SPAC life cycle should expect a lot of attention to the conflict disclosure in the registration document. The next set of comments that came out a couple months later, related to another topic that will be well understood by this group, and that's whether the targets that SPACs have identified and are engaging with are really ready to be, significant components of a public company. There were a couple of situations that I think really precipitated the March comments, but this, and we'll talk about this in greater detail when we get into some of the plumbing of De-SPAC transactions. But the SEC has been and will continue to be focused on the infrastructure within these target companies to comply with the requirements that go with being a public company in the U.S. from a financial statement control perspective and otherwise. And then we get to the more recent pronouncements. One of which, so this one's probably worth a minute of background. The commentary that came out from the SEC, or the head of corporate finance at the SEC in April, was a warning for people to exercise care with respect to forward-looking statements in the context of De-SPAC transactions. The history of this is that, back in the 1990s, the mid-90s, Congress decided that there was too much frivolous securities litigation, and as a mechanism to try to deal with that, they adopted something called the Private Securities Litigation Reform Act. And as part of that, the congressional view was that forward-looking statements can be very useful to investors, but there's the fear of litigation had created a reluctance for people to include forward-looking information in their SEC filings, and so the law created a safe harbor. But the safe harbor under the Reform Act does not actually apply in the IPO context. And so it's created this funny issue. If you think about a SPAC, the SPAC's IPO occurs essentially at the moment that it is created and funded on a blind basis before a deal is identified. And so I think some people in the market were maybe pushing fairly strongly, perhaps more strongly than was appropriate, the message that the great thing about a SPAC transaction is it gives you this opportunity to, at the time of the business combination, include lots of forward-looking information, and the safe harbor under the PSLRA is available to protect those statements. So the statements that were made back in April don't change the law, and the rules are still the rules, but people, I think, are more focused on this issue than they were before the statement came out. And the commentary noted specifically, for example, that there is no definition of what constitutes an IPO in the PSLRA, and therefore, there's maybe scope for the SEC to take a particular position in the SPAC context. And the commentary also noted the possibility that further action, either by the SEC or by Congress, might be needed or appropriate to sort of clarify the guidelines here. So that was an important marker and an important development. And then finally, most recently, there was the accounting side of the SEC weighing in with views on the treatment of the accounting treatment of warrants that are issued in these SPAC transactions, and in particular, whether equity treatment is appropriate, or whether contingent liability treatment is a better way to present these. On that one, that was also clearly a significant development in terms of its impact on new SPAC formation. It caused a wave of companies to go back and look at their financial statements and think about whether they needed to restate. But there's been a great deal of back and forth led by the Big Four accounting firms with the SEC accounting staff, and the expectation is that people are gravitating towards a set of standardized SPAC warrant terms that will address the SEC concerns, and that will support equity treatment. So this one is it's a very active area, but I think lots of the people we talk to are expecting there to be, developments on this one that will take some of the pressure off of this particular issue in the coming weeks or months.
So Carl, these developments that you mentioned, have you seen them actually have a real impact on SPACs, how SPACs are done, or De-SPACs are done, and also do you expect more SEC action going forward?
Well, Ching-Yang, you should jump in too if you have thoughts. I would say we're definitely expecting more SEC action. We know that they are actively looking at a number of elements with respect to SPACs, in addition to those points where they've put down markers. And yes, this has definitely had an impact on the practice. If only, if you just think about the numbers of companies that have gone through financial restatements driven by the warrant issue. So it's absolutely had an effect.
Yeah, and frankly, given all these developments, one question that has been asked by clients recently is always, whether we think, given all these developments, the SEC has an intention to shut down SPAC deals. And what is clear is that both the SEC under both Trump and Biden administration are focusing on regulating the heated SPAC market, but so far, we don't see really any sign of trying to, shut down these deals. But the key takeaways here is really, how to deal with or how to address these SEC concerns in an actual transactions. So, for example, disclosure of conflict of interest, and as Garth mentioned previously, the conflicts of interest really comes from a situation that the upside and downside structure for the sponsors and the public shareholder versus SPAC is very different, given how these economics are structured. So that's number one. But I think number two, readiness, that has been a focus of us when talking to potential De-SPAC targets recently, is that, for many of these De-SPAC targets, they're high growth, they have wonderful business model, they have great technology. But one thing that is missing is, often their financial reporting, internal control. And with that in mind, if, a potential SPAC target, goes on kicks off a De-SPAC transaction, half-baked, then potentially the timetable will be delayed. And, when the De-SPAC is closed, they're exposed to much higher risk, being a public company in the U.S. So I cannot overly sort of stress that the readiness for De-SPAC target is probably, the number one focus of myself in, sort of looking at the recent De-SPAC situations. And the next one is, the projections, forward-looking statements, and all that. And Garth has given a overview and the sort of the historical background of this issue. So I won't spend more time on it. But clearly, the usage of forward-looking statements and projections will be more cautious than before. And then the accounting treatment as well. So all those tells us that, the key takeaway of me personally is that, not every target that wants to go public in the U.S. is a potential, is suitable for being a De-SPAC target. Right? Because, with all these readiness, with all this disclosure requirement, as robust or even more than an IPO situation, and with, all these accounting and governance restrictions, question is, why would a target wants to go on a De-SPAC as opposed to just do a conventional IPO? So I think that's what leads us to the next topic. When we look at the De-SPAC transaction, selecting suitable De-SPAC targets would be very important, and even more under the recent developments of the SEC scrutiny.
Yeah, no, that's a perfect introduction, Ching-Yang. I'll just spend a couple of minutes on, the sort of the categories of targets that have been the principal focus areas for deals to date. We had the discussion a few minutes ago about the Universal Music deal. And, I suppose it remains to be seen whether, in 3 months or 6 months or 9 months when we're having this discussion, there's also a separate column dealing with appropriate minority interest type transactions for SPACs. But to Ching-Yang's point, the first item on this list, early stage high growth companies, has really been the sweet spot. It is, I think, to Ching-Yang's question about what's in it for the target. I think here, we're talking about companies that potentially really see the benefits of a faster route to the public markets than would otherwise be available to them. And that's a combination of various things. They have the ability, subject to the caveats that we just talked about a minute ago, they have the ability to quote, tell their stories, through forward-looking projections, in a way that wouldn't necessarily be available to them in the context of a traditional IPO. And they also benefit potentially from the reputational effect of the people associated with the SPAC that selects them. So there are obviously a lot of very experienced investors with particular areas of expertise and focus that have been involved in founding SPACs. And so the combination of their perspective and background and investing history with the target can be, can result in an attractive and successful story. Just very quickly on some of these other categories, I think, we've been involved in situations where private equity portfolio companies have been considered as potential SPAC targets, and there have been deals done on that basis. There are challenges, particularly with respect to the debt posture of those companies, and the ability to the constraints on the amount of cash that can potentially be available in SPAC transactions, and challenges around refinancing existing debt that these companies may carry. So there's a little bit of a business model mismatch, I think, potentially there that's created some headwinds. An area that people talk a lot about and could also be, it seems to me, fruitful in terms of target opportunities is, divisions of conglomerates, divestiture of business units by larger groups. The question there is, in here, obviously, we're noting the question about whether these are companies that could be market ready on a standalone basis in a fairly quick way to accommodate a SPAC schedule. That's an issue. I suspect more of an issue there is the attractiveness of the SPAC exit and the potential, dilution effect of warrants and so forth from the point of view of the selling company. We've had conversations with people where if unless there's some compelling reason to move quickly, the traditional IPO model might be something that looks perfectly attractive to some of these groups. So, pros and cons on both sides. And finally, there have been deals done involving distressed targets. It's a very small subset, to my knowledge anyway. It's an interesting area, and there may be some more deals to be done on that basis. But given all of the challenges to successfully launching the target, selling it to the investors, the SPAC investors who will have redemption rights if they don't like the deal, and so on and so forth, getting the pricing right is important, and being able to find a way to tell a positive market story when you've got a distressed target is going to be one of the significant challenges there. See why I'm mindful of the time here, so maybe we skip ahead to some of your slides.
Sure. Yeah, that makes sense. So due diligence. Now, very important here is that, from a lawyer's perspective, right? In a De-SPAC deal, what's the right standard for due diligence? Do we get enough due diligence to establish a good defense down the road? If there is an investigation or a litigation. And here, if you look at sort of the recent SEC and sort of concerns about conflict of interest and all that, you'll find that the SEC's approach in many ways is really looking at these SPAC transactions, sometimes similar to the 13E3, take private transactions. So if you look at the common letter that, we've got, we've seen from the SEC, They're asking questions as to why you select the target company, who initiated the contact, and, focus on the, how to determine the nature and amount of transactions and all that. So, a lot of these questions really go to the heart of the question, in a situation where there's a conflict of interest, in a De-SPAC situation, as I mentioned, the sponsored and the public shareholders of a SPAC, they have not fully aligned interest, not fully aligned upside and downside in closing a De-SPAC deal. Similar to a 13E3, take private transaction where the buyer, is interested in the buyer is also, an affiliate of a U.S. public company. The SEC just simply, focusing on the conflict of interest and which, require enhanced due diligence on when we sort of plan out the due diligence plan. Now, if you look at the certain recent concerns that are expressed by the SEC and the practitioners, the economic interest, as I mentioned, and then the time limit, sort of time limited lifespan, typically 24 months, sometimes longer, sometimes shorter. But, when a SPAC is, getting closer to its term, clearly, the sponsors has a very strong incentives to quickly find and close a deal. And then, the intense competition between SPACs on targets, that's something, recently we've seen. So it's all these sort of gives us sort of the background of why due diligence is very important in a De-SPAC transaction.
Jing-Yang, before you carry on, let me just jump in to read the CLE code for people who are wanting CLE credit. The code number is 331472. That's one more time, 331472. And if you enter that on the participant form that's available through the email invitation, you'll be eligible for credit. Thanks. Sorry, Jing-Yang.
No problem. That's always very important for CLE courses. So here we talk about projections, and Garth already talked about the forward-looking statement and projections, so the historical background of it. But here in recent transactions we've seen the SEC asking for a fairly high standard of disclosure for disclosing the assumptions and background of all these financial projections, including in a pre-revenue business, what's the projected growth is coming from? Is it from the existing business line? Is it from the new business line? And also what are the key assumptions? And the SEC is, as always, focused on whether projections are reasonable and in good faith. But looking at the, recent lawsuit situation, now, if you look at the recent lawsuits, the plaintiff alleged that, because the De-SPAC company reported a somewhat disappointing earnings, and the stock price dropped, the plaintiff is challenging whether, when making the projections, whoever made the projection already knowingly know that the projection was not reasonable or not in good faith. So, given both the SEC and sort of the recent litigation situation, due diligence on projections becomes a key.
CY, let me jump in. I got two questions. I apparently did not enunciate very well when I read out the code, so I'm going to do the code one more time for everybody. It's 331472. 331472. 472. Back to you, CY. Sorry about that.
Sure. Okay, so we might need to speed up a little bit. On this slide, we talk about an overview of life cycle of a De-SPAC transaction. So, for the first part of it, it's very similar to an M&A transaction. The only difference that the timetable is highly standard, at least for the traditional De-SPAC transactions. You have preliminary documentation phase for 2 to 4 weeks, and then you go to sort of the negotiation stage 1 to 2 months, and that's really driven by sort of the exclusivity period in the letter of intent that the SPAC and the target enters into. So again, because a SPAC have a lifespan, it cannot afford having a lengthy discussion with a potential target and then deal fails. So it's almost always 45 days to 60 days for a conventional De-SPAC deal until signing. And once transaction documents are signed, it sort of goes to the SEC filing stage, and this is more of closing and regulatory approval process. So that part is different from a M&A transaction. Now, after a De-SPAC deal, you will see the original SPAC IPO investors and the PIPE investors, and we'll talk about quickly on PIPE in a minute. And then the sponsor, the SPAC sponsor, and also target shareholders all becoming shareholders of a SPAC. And also, remember, we talked about warrants, different stakeholder group owns different warrants, and that's sort of essentially the capital structure of a De-SPAC target after the De-SPAC process. Now, here talking about fiduciary considerations, as most of M&A deals for involving a public company, one key question is always sort of the fiduciary duty of the public company's board. Now, here we sort of give a few key considerations for Delaware company, and obviously Delaware company, a Delaware court has a whole set of common law on fiduciary duty. And the key question here again is still conflict of interest, right? So here, we won't bore people by talking about these legal terms, business judgment rules, Revlon, or entire fairness. But the key message here is, given the conflict of interest, the court will have a higher standard, higher scrutiny on directors exercising their fiduciary duty. Now, in a Cayman SPAC situation, because a lot of De-SPAC deals here in Asia involves a Cayman incorporated SPAC rather than a Delaware. Does Cayman, I've always been asked, whether Cayman courts actually apply similar fiduciary duty standard, for these De-SPAC deals. And obviously, we're not Cayman lawyers. We don't, and these litigations are so far not commonly tested. But I think the key takeaway is, Cayman law, Cayman court for these U.S. public company litigations had a tendency of, sort of one step behind the U.S. court, taking sort of take private transactions as an example. In the past, Cayman court used to be relatively relaxed in terms of, finding the directors accountable for, so breach of fiduciary duties in these deals, and also on the, sort of fairness, sort of consideration fairness points. But in recent years, Cayman court has been more and more focused on this and adopt, principles are not the same, but more comparable for Delaware courts. So, for SPACs, given sort of on the U.S. side, people, including the regulators and the plaintiffs are giving more and more focus on it. We do expect that on, sort of on the Cayman side, when we do a de-SPAC deal, we should, also still keep the fiduciary duty in mind. Going to the business combination deadline, we talk about the 24 months of the lifespan of a SPAC. Here on this slide, I think the key takeaway is that in recent deals, it has been developed some of the contingent extension provisions. So how it works is that if a SPAC company can achieve a milestone, for example, entering to a definitive purchase agreement or entering to letter of intent, or even contribution of additional capital by sponsors, there could be a extension of the life of the SPAC so that the SPAC has more time to find a target.
And Ching Yang, how do SPACs reach the end of the lifestyle without a deal, and what happens if that?
Sure.
What happens?
Okay, so in a SPAC, if at the end there's no target, it cannot close a deal, then remember we talked about there will be a trust with all the money put in by the public shareholder. The money will have to be repaid to the public shareholders. So at the end, the public shareholders, takes their initial contribution back, dollar to dollar, and the sponsor will need to bear all the transaction cost, mainly including the underwriting fee, the underwriting commission initially, as well as the legal fees.
And that's where the conflict of interest comes, because the sponsor really needs to close the deal. Otherwise, it will be out of pocket.
Correct. Okay, so I'll just pick a few very important message. Here, the trust account we talked about and the pipe, and again, because the public shareholders can always redeem its contribution for the trust account until a deal is approved by the shareholders. So, the recent trend is that the SPAC trust account money will be used mainly to fund the working capital of the combined company, because the amount is uncertain when the target is negotiating for a deal. What will be a sort of a certain amount is the pipe money, because the pipe investor is negotiating with respect to a specific de-SPAC deal, right? So they don't have the redemption right. Their money is certain. So typically the pipe money will more be used to pay off the target shareholders who wants to cash out at the de-SPAC deal. So I think, we have a few interesting slides here for this one. As you can see, the trend is really that, for a de-SPAC M&A, less cash considerations are used nowadays and more share consideration are used, which means that, for the targets, less shareholders of the targets sort of cashes out, and more shareholders of the target just roll over to the combined company, and that makes sense for a target company where its shareholders are expecting an IPO, right? Because rolling over to a combined company essentially is similar to an exit, post IPO. Although the lockup period will be different. We might get to that if we have time. Here, talking about consideration, earnouts. In an M&A deal, sometimes you'll see earnouts. For SPAC, you'll also see more and more earnouts. Now, about 40% of De-SPAC since this year has these feature. But I think the key difference here, and gosh, feel free to chime in if you disagree, but to me, the main difference here is that in a typical acquisition situation, the target's shareholder will not become the controlling shareholder, or in a last situation where the target shareholder becomes the controlling shareholder of the combined company. But nowadays in de-SPAC transactions, I think majority of it, after the deal, the target's shareholder actually represent more than 50% of the combined company. So the incentives and the dynamics will be different from a typical acquisition situation. And for the earnout milestones, stock price milestones, straightforward, operating metrics, easy to understand. And the third, event-driven milestone is more for biotech companies in our experience. For example, sort of the, certain specific stage of clinical trial would be the triggering point of these earnouts. The next slide that is also very interesting is if you look at this trend, there are decreasing number of de-SPAC transactions that have escrow provisions, and I think a big reason of it is escrow provision really comes from the idea of M&A, but given the SPAC's economics is different from conventional M&A transactions, so I think the market developed this trend for the main for the de-SPAC transactions. Here is the indemnification. So in the past, because the target is a private company, there used to be more indemnification provisions similar to a private M&A, but recently you can see that the trend for the terms is moving much towards a public M&A where you don't have indemnification provisions, and I think one justification is really that the target's shareholder will actually represent a majority of the shareholders in the combined business. We are running out of time, but I think for the sponsor economics, the key takeaway I would say is that because of the competition for de-SPAC targets, you could see a lot of sponsors giving up, as part of the negotiation, giving up their promote shares, giving up their warrants, accept hurdles, accept hurdles in order to incentivize the target company to enter into the transaction. All these attempts is to reduce the dilution of target shareholders post-transaction. Yep, lockups here, the sponsor typically is subject to 6 to 12 months lockups. The targets, on the other hand, is 180 days. Trust account waiver. This is also a very interesting point. So for traditional de-SPAC deals, remember we have this trust account concept. So if the deal doesn't go through, all the public shareholders will take back sort of the monies in the trust account is essentially dollar to dollar. So essentially no upside, no downside. So, different from a typical M&A, in a de-SPAC transaction, the target would give a waiver on trying to get money from the trust accounts. So, in terms of indemnity, damages, reverse breakup fee, all those typical provisions would have this trust account waiver. But Garth, do you want to just make a very quick comment on recent trends in terms of trust account waiver?
Yeah, just very quickly, because I think we're a little bit over time already.
Right.
And I want to talk very briefly about liability considerations. But yeah, the leverage ebbs and flows in these deals, but we've seen various transactions where there's been some pushback against the sort of full and absolute protection of the trust accounts, and some limited recourse made available with respect to for example, specific performance of obligations under the contract, fraudulent inducement to do a deal, and in limited, fairly tightly defined circumstances, damages or expense reimbursement, where certain types of termination scenarios play out. So there's been some movement. I think 6, 9, 12 months ago, you would have found that in most of these deals there was very little in the way of recourse against the trust account, but that's been breached to some extent in recent transactions.
Yeah.
And then, CY, do you have more? Should we jump quickly to liability?
No, I think we should jump quickly into liability considerations.
Yeah, the headline here really is, these deals are increasingly of interest to the plaintiffs' bar in the United States. There has been a fairly significant amount of litigation already, and there will certainly be more. The apparent conflicts, the different incentives that people have and so on, are a very rich sort of an opportunity from the plaintiff's bar's perspective to be advancing claims that fiduciary duties have been breached, that someone was thinking about their own interest when they should have been thinking about the shareholder interest more broadly. So there will certainly be litigation with respect to conflicting roles and fiduciary duties. The other area, beyond the SEC, as we talked about a little while ago, has put some markers down on areas where they're particularly interested. And they will no doubt pay attention to that, and they will no doubt, in the right circumstances, bring their own enforcement proceedings. But from a more general, private litigation perspective, you've got two sort of disclosure moments in the life of these SPACs. The first, in connection with the plain vanilla IPO registration statement for the SPAC, there's not a lot there, right? That's a document. A deal hasn't been identified. It's really just a description of the mechanism around the SPAC, the way the warrants work. Probably the most important piece of disclosure in it, or in many cases, the most important piece of disclosure in it, is the biographical information about the the key people at the SPAC. So there's not a lot there, but the area where there would be fairly significant risk would be if you had a fact pattern where the SPAC sponsors or people connected to them had actually been, thinking about pursuing, lining up, having conversations with a particular target, and didn't disclose or reference that. That would be the thing that you'd probably be most focused on from a risk perspective in terms of the initial document. And then obviously on the, when you get to the actual De-SPAC transaction, and the disclosure around that, the thing that we've seen in the headlines has been, and the thing that the SEC put a marker down on has been the use of projections. And there have been a couple of recent situations where, there's been adverse outcomes for people who were involved in relying on or producing projections that were very difficult to substantiate. And so that's going to be an area that people need to keep an eye on. So broadly, those are the main buckets to worry about. But I think we're already a few minutes over, so I don't think we need to get into much more detail. And we've kind of covered this from different angles over the course of the discussion, I think, in any event.
Okay. I think we sort of got 10 minutes over. We've got a few questions, and I guess maybe we'll just reach out to the audience who raised questions. And at the same time, if you have any questions about De-SPAC, either from market trend, from execution, from its legal aspects, feel free to reach out to any of us, and we'll address those questions.
Yeah, absolutely. There's a lot. We had to, just because of time, we had to sort of fly over the material at a pretty high level. But we tried to include some pretty useful data, some pretty some stuff that will hopefully be of interest. And if people are going through that after this discussion and have questions, obviously, as Chin-Yang said, don't hesitate to get a hold of any of us. We'd be delighted to hear from you.
Okay.
All right. Thank you very much.
Thank you, everyone.
Thanks, everyone, for joining us. Thank you.
Bye-bye.
Bye.
Thank you for listening to S&C Critical Insights. For more information about our practice, please visit us on the web at www.solcrom.com.